So yeah, so today we're just going to be discussing the 5 mistakes that new first-time homebuyers typically make when purchasing their first home. And it's something that it may not be the top 5, but it's something that it is common, and we see it on sort of our end as lawyers, that these are issues that come up with clients and people when they come to see us to essentially close their deal of the purchasing a new home. So, so one of the first things is this with overlooking their budget. So they want to typically, people get excited. They find a house that is nice. It's meets their needs. It's in a good neighborhood, but it may ultimately be though that they haven't potentially considered what the actual budget would be, not only for closing the deal, but then also the month-to-month costs as to whether or not they can actually afford it and it's within their budget as well. So when people are purchasing a house, one of the main things is that there's a difference between when they put a deposit down on the house and then their actual down payment. A lot of people get kind of the misconception that part of the deposit is in the down payment itself, when it's only actually part of the down payment. So they will take that into consideration, how much you're putting as a deposit, maybe $1,000, maybe $5,000. But then ultimately, depending on your lender, you're going to have to put a certain amount down. Usually it'd be 5% or it could be 10% in order to purchase the actual house. Those fees will not normally be known to the client unless they've asked the proper questions through the realtor, through the mortgage broker, or contacted a lawyer before they entered into the contract. So we normally, when we're meeting with clients, it's typically after the contract's been executed, and then we get funding instructions from the bank for the mortgage, and then we're about to meet with them to then sign up and essentially close the deal. One of the biggest surprises is that there's a cash to close amount in order to finalize the deal. So that would be then the deposit plus the legal fees for the closing of the deal. Also, there might be other adjustments for property taxes. There might be condo fee adjustments. There might be tenanting adjustments. And then most importantly, there's also the rest of the down payment that they agreed to with the bank that they'd also have to pay as well. Because the bank doesn't fund the entire amount. There's going to be the deposit amount. It would not be entirely funded. It's going to be that you have to pay for a certain percentage in order to purchase the house. Mm-hmm. So they have to realistically take into consideration that that's something that they normally have to have those funds in hand. They can't borrow that money unless it's through like a gift letter or something like that, and that the bank is actually already aware of that. So that's one of the main things. The other part too is that in terms of budget-wise is the monthly budget. So there's going to be the monthly costs, being the mortgage costs, the maintenance fees, the property taxes, property insurance, which is a requirement for people then mortgaging a house, and then also utilities. So people, when they're looking at a budget for purchasing a property, they want to make sure that they're taking all those things into consideration, and that they also are able to afford in the event that there's a job loss, they get injured, they get sick, they're unable to work, or they're things that come up like they're going through a separation, something like that, that they have like a extra surplus and an emergency fund available, so that they can make sure that they're not going to one mortgage payment or one tax payment behind, because once that you do get behind on those things, it can be it can definitely start to add up, and it can definitely start to create a lot of extra problems that people aren't even aware about.
So I'm gonna just quickly interrupt you there. I have noticed that when you're doing the mortgage calculator apps online, some come with the option to add utility bills, property taxes, and any extra expenses, whereas some apps only show the mortgage payment.
Right, and that's I think where there's that's the problem, is a lot of people rely on the simple budget one instead of actually looking at the more complex one. And you have to get realistic quotes, whether it's from friends or family or other people who have like Direct Energy or Aquaterra, and all of those costs have been going up. And so people need to actually have a realistic idea of like, well, how much money is this actually going to cost me on a month-to-month basis, right?
Exactly. Yeah. Okay.
Yeah. So the other part too is that when people are purchasing a property, is that they also have to understand, as I mentioned earlier, is that we as lawyers are already at the point where you've executed your contract. You're now coming into our office. So it's almost like the 11th hour where we now have bank instructions, mortgage instructions from the bank, and you're coming in essentially to our office to close the deal. The problem is that a lot of people, they don't realize this, but you as a purchaser have the ability to put conditions within your contract, right? And it's something that you should always, try to get put in place, is that there's some type of conditions of purchase, whether it's for approval of financing, whether it's to get an inspection completed, whether it's to do a walkthrough through the property, whether it's that there are certain appliances and certain fixtures that you wanted added in to the property, whether, for cleaning, you want the property cleaned properly and professionally cleaned, junk removal, substantial repairs and upgrades. And so at the end of the day, you don't want to go and purchase a place unconditionally with no conditions in the contract. Because us as lawyers, if something goes wrong and there's an issue like with funding, or there's an issue with the quality of the home, or there's an issue with tenants that were previously in the home, we essentially, without having conditions in that contract, it's really difficult to then have somebody set aside that contract without the purchaser actually incurring where they lose their deposit and extra costs and so on and so forth. So with there being conditions within the contract, we do have the ability to actually then navigate within the contract rather than completely breaching the contract, which then ultimately leads to potential litigation and costs. Mm-hmm. So the other thing too is also, don't be pressured as a purchaser to release the conditions or lift the conditions. Again, so you're, as the purchaser of the property, try to be the person who's in the driver's seat. You're driving the bus, and you don't want it to be then where you're being forced to then make it an unconditional contract. You always want to at least have some conditions in place that when you're meeting with the lawyer, there is some navigation available there that we can then potentially work with the seller or work with the realtors on both sides and try to get a more reasonable agreement in place.
So just so that people have an idea, percentage-wise, what would you say, how many contracts end up being breached or litigation ensues or a lawsuit?
Well, it's not so much like percentage-wise. I think it's that there's a lot that could be potential litigation, right? Okay. But the problem is ultimately, though, if you don't put the conditions in, you're ultimately forcing yourself into a position where you're almost becoming the defendant automatically in a lawsuit, because you're the one who's now in breach of the contract by not fulfilling what you've now agreed to. Because in an unconditional contract, you've agreed to purchase this house essentially as is where is, and it shouldn't be like that. You should be purchasing the house under the understanding that the house is in good condition, that it's clean, that it's suitable, that it's exactly what you through the walkthrough. A lot of people, like you put a lot of trust into the previous tenants, and you don't realize, like, well, if there's no conditions in there, they could damage the property. They could remove fixtures. They could go and take out the appliances. There could be a whole bunch of extra issues that come up. And if there isn't conditions in relation to the contract, essentially you're the one then as you're becoming the defendant, because you've now breached the contract by now raising these issues and not following through with what you agreed to.
So if we can simplify that, then the conditions are some kind of a safeguard for the buyers that they have to be met in order for us to proceed to the next step.
That's right. Right. Yes. And it can also be that there's conditions in stages, right? So there could be, like, for example, that there is a condition of financing approval. Well, that's something that, the other thing is that people don't realize too, when you're qualifying for a house, if you don't have more than 20% down, you may be pre-approved by your financial institute to purchase the place, but you may not be approved by CMHC because you have to have more than 20% down in order to have it a non-insured mortgage. So that might then also be a massive roadblock that then ultimately inevitably leads to the conditions not being, if there's no conditions in there, essentially you've now again breached the contract because you can't get approved for financing. So you could actually put that into the contract saying that you want to have the conditions in there for financing approval. And it can be vague as that, because, well, that financing approval could cover anything, right? And so ultimately it gives us, the lawyers, the ability to then have an out if something does go wrong.
So just to clarify for the audience, the minimum down payment for a primary residence is 5%?
That's right. Yeah. So 5% is, I think it's in Alberta or in Canada is the 5%, but then it also depends on the value of the property. So if it
Right.
goes over $500,000, then I think it's 5% on the first 500, and then it's going to be, I think it's 10% on the next 500,000. If it goes over $1 million, then it's going to be, I think it's 20% that you have to have down.
Okay, so that's
Yeah.
something that people have to do their due diligence and make sure they check.
That's right. And then ultimately, those percentages, they have to realize that those amounts for the down payment are essentially due on the date of closing. So
Right.
we have to have those funds in order to close the deal.
Okay.
So yeah.
And for any rental property, whether it's your first purchase or second purchase, minimum down payment is 20%.
It depends, yeah. So, but the thing is that from a legal perspective, yes, because of the fact that you have to disclose that it's a rental property, but that's a whole nother area too, because there's certain people who may not be purchasing the place and then properly disclosing the fact that it is in fact a rental property. If someone does that, ultimately they're already in breach of their mortgage, right? Okay. That's a whole nother area too, and there's a whole bunch of different new rules and stuff that do apply to for rentals, and even like for more complex rentals like Airbnbs and that kind of thing as well. Okay. So ultimately though too, the other thing too is that with if it is a rental that you're intending on buying, just be honest and forthright with your mortgage broker from the beginning, right? Because they can make adjustments through that. If you don't tell them that it's a rental, inevitably we as lawyers, we actually have to get you to sign a statutory declaration saying that this is going to be your primary residence and no portion of it will be rented out. So you're going to run into that wall at that point where potentially if you have not completely disclosed to the mortgage broker or told them at all that this is what the intention is, that inevitably you're going to run into that point where it's going to say like, you have to now declare that you're not going to rent this out. Right? Okay. So another one too is a big mistake as well is skipping home inspections. So people typically, again, are buying the house as is where it is. And it's the problem is in Grande Prairie especially is that there's a lot of older homes that are basically just get a lot of facelifts, right? So people go in, they renovate them, they put on some new paint on the interior, some drywall work, some framing, some siding, and those kind of things. But there may be like latent defects that people are not aware of because you can't actually physically see those things. It's very important that you, before you purchase a property, that you get an actual professional home inspection completed, because there may be issues, major issues, that then are going to end up going back to your budget as to whether or not you're able to afford this, such as, the frame or the foundation could be cracked. There could be issues with the roof. There could be issues with the plumbing, with the sewer, with the electrical. A lot of homes in Grande Prairie have older electrical systems. They also have older furnaces. Those are things that may require an immediate upgrade, and then ultimately you need to be able to factor that into your overall budget. Okay. Yeah. Another one as well is that people don't understand what CMHC insurance is, or default insurance is. It shouldn't be the norm. It should actually probably be the exception, where people try to purchase their first home without CMHC insurance. The problem is that I don't think a lot of people understand properly what happens in the event of a default between a conventional mortgage, which would be where you have more than 20% down on the mortgage, or a CMHC insured mortgage, which is where you have less than the 20% down, and then ultimately have to contract not only with the bank, but then also with the CMHC insurance or the insurance provider. There's different types of default insurance, but inevitably it's ultimately just CMHC insurance, so it's called. So what happens is that with a conventional mortgage, the bank's remedies are essentially that they can seize or sue. They can foreclose on the property, or they can basically sue you for the deficiency or the shortfall, but they can't necessarily do both. So they can then, if you go into court for a foreclosure proceeding on a conventional mortgage, there's going to be an arrears amount that's owing for the unpaid mortgage payments. You're also going to be provided a redemption period to redeem the mortgage. In order for you to redeem the mortgage, you just simply have to then pay the outstanding arrears, and then it's back in good standing. There's immediate stay of proceedings for the foreclosure proceedings, and then you're back on track, and there's no further issues. A CMHC insured mortgage is a lot different. So in the event of a default, there's typically, the problem is a lot of people don't phone their bank and let them know that they're going to be late on a payment. The bank doesn't know, so they have no communication with the client, and inevitably they end up unfortunately making the call to CMHC insurance, who then will then start the enforcement proceedings on their behalf. There's an automatic legal fee. It could be anywhere between $5,000 and $7,000 automatically for CMHC insurance getting involved on a file.
Oof, that's substantial.
Right. And then what ends up happening is that with the CMHC insured mortgage, is that then it isn't just the seize or sue. So what they do is that it starts the foreclosure proceeding, and in order to then redeem a CMHC insured mortgage, you have to actually pay out the entire mortgage.
Oh, wow.
Yeah. So then the other thing is that in order to pay out the entire mortgage, you also have to look at, well, how far into the mortgage are you, right? So if you're only a year into a 5-year term, or, and you got to think there's 5 blocks of 5 years in each mortgage, right?
Mm-hmm.
So if you're only a year in, well, then you're going to incur there's going to be the early payout penalty, which is going to be 3 months of interest or the interest differential, and whichever is highest. Which, if you're only a year in, it could be, it could be $10,000, $15,000, $20,000 penalty just for the mortgage being broken at that point. Then for the CMHC insurance, there's also the premium that was then basically loaded into the first 5 years. You would have to then pay out the rest of that. And then on top of it, the legal fees for the bank or CMHC initiating the foreclosure proceedings. And then on top of that, they'll also go and they'll get an actual appraisal of the home. And if it turns out that, say, the appraisal says that the home is worth $200,000, but there's $220,000 still owing, they will then, through court, get a deficiency judgment against you for the $20,000 plus the legal fees. So it can be pretty significant, and it becomes pretty serious. And so that's why, again, it flows back into the whole idea of the budget, so that if you don't have that emergency fund available, and there's the potential that, you're right at the red line in terms of your budgeting, it's super high risk to go in and get a CMHC insured mortgage, because if you suddenly get sick, you get injured, you don't have proper insurance and stuff in place, you default on that, all of this stuff can then simply start happening. Mm-hmm. And a lot of people don't know that until they come and talk to the lawyer, and then suddenly it's a big eye opener, because it's, oh wow, I didn't realize that. Okay. And so it's definitely something that people need to take into consideration, because it is definitely serious, because you don't want to be where you're a first-time home buyer and then inevitably you default on it because you can't afford these things, and then you're forced into a situation of almost bankruptcy.
And like we should tell the people that we have quite a few foreclosures here in Grande Prairie.
There is, yes.
Right? Foreclosures, yes. Judicial sales. So
that's right.
It happens all the time.
Yeah.
Right?
And the banks are aware of this stuff, and so the thing is that if you're going into tough times and you already have a mortgage, and you're going to miss a payment, just make sure you contact your bank and tell them, and you're going to say, okay, you work out your payment arrangement, because the worst thing to happen is that people don't talk to their bank, and then inevitably it's that phone call or email gets sent over to CMHC, and they get involved, and then it can become bad in a hurry, right? So.
Just like in a relationship, communication is key, right?
That's right. Yes,
yeah.
Yes, exactly.
Okay.
Yeah. So the last point is also where people are neglecting the mortgage terms or not completely understanding the mortgage terms. So when people are buying a house, they have to understand is that basically, there's a lot of misconceptions about interest rates and stuff, right? So interest rate right now is like, it could be 5.2, 5.7, however high it's in the 5% right now, right? So the way that a mortgage works is that it's a 25 years, usually 25 years, right? Mm-hmm. So it's normally on as 5-year blocks. So those 5-year blocks all together, well, 5 times 5 is 25. The way that a conventional mortgage works is that they basically will say that you make these payments, and the way that they've calculated out, you make these principal and interest payments over 25 years, this exact amount that we've calculated, you will then pay off your house in 25 years. If you made those payments.
So just to clarify for the people, the 25 years is the amortization.
That's right.
And the 5 years is the term.
That's right.
Okay.
Yeah. So once that the 5 years is up, you then would have to then do a renewal at that point. And then it's going to go for another 5 years, and then you do another renewal, and then it's going to go for another 5 years, right? So the way that the mortgages work is that, again, it's all based on, there's a pre-calculated amount that then is that this is the 25-year term. A lot of people don't understand the fact that if you change the frequency of your payments, you can actually pay off your mortgage quicker because of the way that the calculator works for the interest. So if you go where instead of doing and this is the most basic one, is that say you have a monthly mortgage payment of $1,500, and then you turn around and you say, well, I want to do a semi-monthly payment.
Bi-weekly.
No, that bi-weekly is different. So
okay.
semi-monthly would be like the 1st and the 15th.
Oh, okay.
Okay. So then what's going to happen is with the semi-monthly payments is you're actually going to be paying still $1,500 a month. It's going to be split though into 2 separate payments of $750 per month, or sorry, $750 on the 1st, $750 on the 15th, right? Just by switching that, you've now knocked off an entire year off the end of your mortgage. So 1 full year that you don't have to pay at the end of your mortgage because you've ended up paying it off quicker. Now, biweekly is different. Now, biweekly, though, you have to think of it as the same as people get paid biweekly.
Every second Friday.
It's right. So it's every second Friday, but the problem is that there's going to be 2 months out of the year where you're going to have to pay 3 times.
That's right.
Right? So there's 26 payments in a year. So biweekly, though, if you're able to do the biweekly, you would actually then end up taking it down to 22 and a half years off of the end of the term. So people don't really understand that. And again, it goes back to the budgeting aspect, is that you want to be able to then, especially with the interest rates the way that they are right now, you want to actually be able to not only be able to pay the monthly payments, but you want to be able to adjust it to potentially go to semi-monthly or to go to bi-weekly. And then you can also do a bi-weekly accelerated. And what ends up happening then is that any extra payments, if there's also what's called prepayment privileges. So you can usually pay up to about 10% or 20% per year of the total amount. So if you have a $200,000 mortgage, you could pay up to $20,000 if it's 10%, or $40,000 per year onto your mortgage without being penalized. So the interesting thing too is that, our generation, our parents are always pushing for like RRSPs. Well, any extra money you got to put into RRSPs. Well, it's just deferred income. You're going to get taxed on it later on. The interesting thing with homes is that if you have the ability to then even put away an extra $100 a month over your $1,500 a month payments, so you pay $1,600 a month instead of $1,500, so you pay that to the bank, that extra $100, over 5 years, you've actually then gained an extra $6,000 in equity in the property after that 5 years.
It's amazing what an extra $100 a month will do for your savings, right?
Yeah, and same thing, like, if people get like a tax return back, or they get a bonus through work or something like that, it's something as a younger person and a first-time home buyer, you definitely want to put it into your home as your principal residence, because the other interesting aspect of it is that it's actually one of the assets that when you turn around and sell that, it's non-taxable. Well, guess what RRSPs are? They're taxable, right? So it's a different way of thinking, but people need to understand that they can actually save money, and then they can actually gain equity in their property, and then they can grow it. And then when they turn around and sell their place, then they have equity in it that they can use to purchase another place, and then hopefully get to the point where they're over that 20%, and then CMHC is no longer on the new property that they're buying, right? So
in my case, years ago when I owned my first house, it was a cheaper house. I ended up pulling a whole bunch of RSPs. So I ended up paying income tax on the extra income, about $5,000. But because I paid my house off in 10 years, I ended up saving $40,000 in interest.
Right. Yeah.
So I paid 5 here, but I saved 40 here.
Right.
Right.
So then it's like, yeah, exactly. So it's like, well, which one is a better investment as well, right?
Yes.
Yes. So that's one big aspect of it, is that the fact that, you need to incorporate that into your budget, because of the fact is that you want to, especially with the way the interest rates are right now, to be able to pay more. Because I think it's right now, it's about, with the 5+% interest, it's about 75 cents per dollar that you put towards your mortgage payment is going towards interest. So when you work that out over a 5-year term, well, how much is it then that you're gaining in equity? Well, it's not a lot.
No.
So you need to take advantage of that stuff, and your budget needs to be able to, like, your stress test should be taking that in consideration, that I'm going to have like an extra, $500 or $1,000 per month. And then I can decide, well, I'll put a 200 here, 300 here, 1,000 here, right?
And most mortgages will allow you to, let's say your mortgage payment is $1,500, you can up it to $1,550, and then you can up it to $1,600, and I believe most of them will allow you to double your mortgage payment. Right?
Yeah, pretty much. Like when you use like the prepayment privilege amounts, and because it's basically over the course of a year, you can make some pretty significant payments towards your property. So the other part of it too is also with the 5-year terms, is that people also don't realize, like, like if you have the intention of renovating a property and then turning around and selling it, like flipping it, or using it as that type of, to gain some extra income and some equity in the property, you need to also understand the fact that, again, you're locked in for 5 years. So you need to calculate that out properly, because again, almost every mortgage says within it that if you break the term of the mortgage, being selling it or paying it out early, it's going to be then where you have to have that payout penalty. And that payout penalty is then going to be either 3 months of interest or the interest differential, depending on where and when you're selling it. So they need to realize that you're going to be locked in for 5 years if you're purchasing this place. So the best time to then potentially sell that property is probably close to the 5-year mark, because then it's only going to be the 3 months of interest, right? You're not going to be paying a significant interest differential, because again, going back to the fact that it's 75 cents on the dollar that is going towards interest. Well, if you're only a year in to your mortgage, that 75 cents on a dollar calculated out for the next 4 years, the bank is out a lot of money. And they're going to turn around when you sell it. They could potentially then say that prepayment penalty is that 4 years of that interest differential. So people understand that. So it's like you have to realize that around the fifth year is probably the best time to sell. And then once you're going to sell it, don't just simply allow the mortgage to then just auto renew on its own. If you want to sell it, you need to then talk to the bank, and then you want to go into an open or a variable at that point. Because then when you sell it with an open or variable, there may be a higher interest rate, but inevitably with that, there's only going to be 3 months then of the penalty to pay it out. So then that's something that people need to understand, because it's like they come in and they want to do this stuff, or they want to renovate it, they want to but then they don't realize inevitably, well, unfortunately, due to what you've agreed to, you're potentially locked in for that 5-year term.
So if I'm in the business of flipping houses, then my best option would be to get an open mortgage.
Depending on again, depending on the stress test at the beginning though, because you can't go, if you're only putting down like 5 or 10% down on the property, well, you're not going to have enough to then flip it right away, right? So if you're getting to the point, like normally with your first home, you want to then say, okay, I'm going to put in a bunch of extra prepayments into this mortgage, so that then when in the 5 years comes up, I can then turn around and sell it. You're going to have a whole bunch of equity coming out of that property, which then you can use to then purchase another place, right? But if you're going and you're saying, okay, well, I'm right at the cusp here, like, I can't afford to make my payments, or I can barely afford to make my payments, and then inevitably I want to sell this place and make a profit off it. Well, you're probably not going to make a lot of profit off it, because of the fact is the 75 cents on every dollar, you haven't really gained a lot of equity at the end of the day in order to even afford to sell it. Because then again, when you sell the property, you end up then where there's going to be the legal fees associated with the sale, there's realtor fees with the sale, there's all these extra costs, and so it's that at the end of, inevitably there may not be where you're making profit off of your investment. But then if you are having enough equity in the property and you put enough into it, and then that then by using, renovating it, upgrading it, you can actually turn around and sell it for more, then yes, you potentially want to go into an open or variable, because then the interest or the actual payout penalty is going to be a lot less. So it all depends on everybody's circumstances. But these are definitely questions that people should look into before they come and, inevitably sign up a contract to purchase a place.
So if you're someone that struggles with math, which unfortunately a lot of people do, it's essential to have a good accountant that can go over these numbers with you.
Well, even like, it's not even like, it doesn't have to be an accountant. It's that they should be able to go through it with their mortgage broker as well.
Okay.
Because their mortgage broker should be able to discuss it with them and say, this is realistically what this budget's going to look like. Because you can go and you can say, okay, well, based on the square footage of this house, based on the neighborhood, this is roughly what your utilities are going to cost you, right? And so there's direct energy, or there's power, ATCO, there's Aquaterra. These are what your fixed costs are. This is your garbage fees, for pickups and pickup garbage, that kind of stuff. This is your property taxes, right? You'll know ahead of time, this is what my property taxes are, and then you're going to pay those probably on a month-to-month basis. And you have to incorporate that all into your budget. And then on top of it, the cost of food, groceries, everything else, your vehicle expenses, like all of that stuff needs to be taken into consideration when you're purchasing a place, to make sure that more or less you're not one paycheck away from all of these dominoes falling down and then ending up in a bad situation.
Yeah. Okay.